Collateral kings, DEX, stablecoins, and the $13 trillion Eurodollar opportunity. 1. Introduction. Crypto's first act was about digital money. Its second act is about digital markets. The rise of decentralized exchanges, or DEXs, marks a turning point. Borderless, permissionless marketplaces where anyone with an internet connection can access financial assets once locked behind banks and brokers. Unlike a savings account with a regional bank, a DEX is a global trading floor, open 24/7, accessible to anyone, everywhere. At the center of this shift lies collateral. And in crypto, collateral means stablecoins, tokens backed by US Treasuries, which are increasingly the foundation of global liquidity. Among them, USDT has emerged as the dominant settlement asset, powering most trading pairs across the new wave of high-performance DEXs. The implications are enormous. USDT is not just a trading convenience, it is a bridge for $13 trillion of offshore Eurodollars, capital that has long been locked outside the gates of US financial markets. This is why DEXs are the next hot thing in crypto. They are not just evolution, they are revolution. And their rapid experimentation, their Cambrian explosion, is reshaping the global financial order. 2. The Cambrian explosion of DEXs. In 2021, GMX pioneered the first wave of decentralized perpetuals. Since then, the ecosystem has exploded into a dozen serious contenders, each experimenting with different architectures and feature sets. GMX, the early mover, built on Arbitrum, introducing perpetuals with pooled liquidity. Hyperliquid, ticker HYPE, a custom Layer 1 blockchain with sub-second block times and on-chain order books. Avantis, ticker AVNT, Arbitrum-based, offering 500 times leverage and synthetic access to real-world assets like forex, indices, and commodities. Aster, ticker Aster, Binance-backed, EVM multi-chain with capital-efficient liquid staking derivative collateral. MyX Finance, ticker MyX, cross-chain zero-slippage perp DEX, aggregating liquidity across more than 200 chains. SunPerp, Tron native, USDT-centric, with incentives tied to Justin Sun's ecosystem. The diversity is staggering. Some are Layer 1 sovereign chains, others live as Layer 2 protocols on Ethereum, some focus on capital efficiency, others on speed or asset breadth. The reason is simple. The marketplace is the window to generational wealth. Whoever builds the most liquid, accessible, and capital-efficient DEX wins the future of finance. 3. The collateral battleground. The core differentiator in this new DEX arms race is not leverage or asset choice. It is collateral models. This is where the only in crypto magic lives. Capital efficiency, Aster's edge. By allowing liquid staking derivatives like AsBNB to be posted as margin, traders can keep earning staking yield while using the asset as collateral. Nowhere else in finance can capital work double duty like this. It is pure capital efficiency, and it creates fresh demand for staking tokens. Tokenized real-world assets. Avantis edge. Avantis pushes beyond crypto, letting traders speculate on forex, commodities, and indices. Collateral is not limited to stablecoins. It stretches to synthetic exposure, effectively turning US Treasuries, gold, or oil into tradable margin for a global user base. Custom chains, Hyperliquid's edge. Hyperliquid built its own chain to optimize for collateral efficiency at the protocol level. Fast finality, on-chain order books, transparent liquidations. Its Layer 1 status means it controls the collateral flow without relying on Ethereum. Cross-chain pools, MyX's edge. By aggregating liquidity across more than 200 chains, MIX collapses the fragmentation problem. Collateral can flow seamlessly across blockchains, opening up stablecoin and token liquidity, no matter where it originates. USDT native collateral, SunPerp's edge. SunPerp leans hard into Tron's dominance as the primary home of USDT supply, optimizing for direct stablecoin margin trading at scale. At the heart of each design is the same realization: whoever captures collateral captures the market. Stablecoins, liquid staking derivatives, and tokenized real-world assets are not just margin. They are growth engines that attract capital into the ecosystem. 4. The stablecoin core collateral in crypto is not gold bars or bank reserves. It is stablecoins. And among stablecoins, USDT has pulled into the lead. Trading pair dominance. Across perp DEXs, most tokens trade against USDT, not USDC. That matters because it means the lion's share of trading demand is flowing into Tether's reserves, not Circle's. Treasury-backed collateral. Every new USDT minted is backed by short-term U.S. Treasuries or equivalent assets. In effect, traders betting on Bitcoin, Mag 7 stocks, or tokenized commodities on a DEX are indirectly buying U.S. government debt. Eurodollar absorption. Offshore U.S. dollar deposits, the $13 trillion Eurodollar pool, are historically locked outside of direct access to U.S. equity markets. USDT offers the bridge. Foreigners can swap Eurodollars into USDT, then trade U.S. assets in tokenized form on DEXs. This is a tectonic shift in access. Plasma, ticker XPL, Tether is now building its own Layer 1 Plasma chain, optimized for stablecoin settlement, zero-fee transfers, enterprise throughput, Bitcoin-anchored security, and Ethereum-style smart contracts. It is the industrial-grade settlement rail to scale USDT into the world's default collateral. Stablecoins are not a sideshow. They are the collateral core of the new financial order. And USDT, with its offshore reach and Treasury-backed reserves, has positioned itself as the kingmaker. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. 5. Regulatory tailwinds. Even as DEXs race to innovate, the regulatory winds are shifting in their favor. In September 2025, the U.S. CFTC signaled support for tokenized collateral, explicitly highlighting stablecoins as eligible margin in derivatives markets. This is no small thing. It is the first step toward embedding stablecoins inside the regulated backbone of global finance. Wall Street sees the same opportunity. BlackRock and others are pouring resources into tokenization, not out of curiosity, but because tokenized assets are easier to settle, collateralize, and trade across platforms. The logic is simple. Once something is tokenized, it can be listed on a DEX, pledged as margin, or wrapped into structured products. This is where the regulatory push and the crypto-native innovation intersect. The CFTC's green light for tokenized collateral means stablecoins are not just tolerated, but embraced as structural liquidity. And that means the DEX experiments, capital-efficient collateral, tokenized real-world assets, cross-chain settlement, are aligning with institutional goals. The loop is closing. Tokenize it. Trade it on a DEX. Use it as collateral. Back it with treasuries. The outcome is a financial flywheel where stablecoin demand both powers decentralized trading and reinforces U.S. debt markets. 6. Macro implications. The implications are sweeping. DEXs as demand engines. Every innovation in perps, whether it is Hyperliquid's custom chain, Avanta's 500 times real-world asset leverage, or Aster's liquid staking derivative collateral, ultimately drives more stablecoin demand. That demand creates a structural bid for U.S. treasuries. Banks shrink into utilities. Traditional banks, already weighed down by regulation and legacy infrastructure, cannot compete with borderless, permissionless, 24/7 global marketplaces. They will consolidate, merge, or fade into specialized roles as capital migrates onto crypto rails. Global market access. For the first time, a trader in Lagos, São Paulo, or Jakarta can directly access exposure to U.S. equities, global forex, or commodities without going through a broker or bank. The window to generational wealth is being pried wide open. Tether's prophecy. Once dismissed as opaque and risky, Tether is emerging as the collateral king, the bastard child of Bitcoin, crowned king, as one prescient post from 2021 put it. With Plasma Chain, Tether is industrializing stablecoin settlement, capturing Eurodollars, and embedding itself into the core of global finance. 7. Conclusion. The battle for the future of finance is no longer about who mints the most tokens or builds the flashiest app. It is about who controls collateral. In crypto, collateral means stablecoins, and stablecoins mean U.S. treasuries. Every dollar of margin on a DEX is tethered literally to the world's most important debt market. And with USDT dominating pairs, backed by treasury bills and now scaling through Plasma Chain, the path for $13 trillion in offshore Eurodollars into tokenized markets has been cut. DEX are the demand engines. Each new permutation, Aster with liquid staking derivative collateral, Avantis with real-world assets, Hyperliquid with its own Layer 1, MyX with cross-chain pools, SunPerp with USDT native incentives, is a different strategy for pulling collateral into the system. Their Cambrian explosion is not noise. It is evolution in real time, fueled by the race to capture stablecoin liquidity. Regulators are aligning. The CFTC is legitimizing tokenized collateral. BlackRock is tokenizing treasuries. Wall Street is circling stablecoin rails. Each step confirms the thesis. Once an asset is tokenized, it is only a matter of time before it can be traded, collateralized, and integrated into a global, borderless market. The irony is rich. Tether, once seen as the shadowy offspring of Bitcoin, is now being crowned king of collateral. Banks, once unassailable, are shrinking into utilities, and the world's capital, from Lagos to London to Lima, is gaining a permissionless window into generational wealth. The new financial order is here. Collateral is king. DEXs are the battlefield. Stablecoins are the bridge. And the $13 trillion Eurodollar opportunity is the prize. Chart 1. Stablecoin market capitalization. $294 billion. Slide shows Defalama's stablecoin dashboard. Ladies and gentlemen, what you see here is the foundation of the new financial rails, stablecoins. The total market capitalization today sits at just under $295 billion. Notice the dominance breakdown. Tether, USDT, over $173 billion, representing nearly 59% of the market. USDC, about $73 billion, a distant second. Then much smaller players like DAI, Frax, and others. The key takeaway: Tether is the liquidity layer of global crypto markets. If you want to trade on a decentralized exchange, odds are you're settling in USDT. That puts Tether at the center of the collateral web, and by extension, the $13 trillion Eurodollar pool sitting offshore. Chart 2. Perpetuals DEX volume, $50 billion in 24 hours. Slide shows Defalama's perps dashboard. Now let's move up the stack to where those stablecoins are being deployed. Perpetual decentralized exchanges. This chart shows total 24-hour trading volume across DEXs at around $50.6 billion. Here's the leaderboard. Aster, over $21 billion in daily volume. Hyperliquid, nearly $9.7 billion. Jupiter Orderly, Drift, and others spread across the middle tier. And here's the kicker. GMX, the pioneer in perp DEXs, now sits at only $310 million, a fraction of its successors. The message is clear. We are witnessing a Cambrian explosion in DEX development. Capital is flooding into platforms that offer new collateral models, higher efficiency, and broader asset coverage. GMX isn't dead, but the market has decisively moved on. Put together, these two slides tell a coherent story. Stablecoins are the monetary base. Perp DEXs are the trading layer. The fusion of the two is creating a new, borderless financial system that rivals traditional banks and exchanges.